like to call on stage Walter Palma from Caixa Geral Depositos, Caixa BE, to let us know what are the secrets of the VCs that they don't want to tell us about.
Okay. Great. Well, thank you for having me. I guess the first secret I have to point out, there are no secrets, really. I mean, NSA knows everything. So, but really, like I said, I mean, obviously, a lot of this stuff, some of them are secrets. I mean, I would say not secrets, but I guess different ways of the way VCs see things versus the traditional view of entrepreneurs, and just try to obviously just go through some of the points and, try to bring, some insight to eventually your future contacts when talking to VCs and when trying to raise capital. Okay, so I guess the first secret, which I think should be no. How do I do this? Here we go. The first secret really is that, a lot of times, when we talk to potential entrepreneurs or entrepreneurs, and I say, oh, we've got this great idea, you've got to invest in it. And the reality is, when you're talking to a VC, you're talking to someone that's relatively institutional. And, oh, sorry, going ahead of myself. Relatively institutional, and the reality is that VCs don't invest in ideas. What we invest in are businesses. So for us, it's more than just the idea. What we want to see is a good idea joined with a good team, joined with a good market opportunity that provides, the potential to grow into a potentially successful future business. Okay? So really, that's really what we invest in. The ideas themselves are important, but we know that successful startups are more than just a good idea. Sometimes it's a good team. Sometimes you can have a good idea that with a good team within 6 months' time will be a totally different business or a totally different idea. But the team still exists and the project goes forward. Okay? Second thing I think is very important when you're talking to a VC, when you're trying to obviously get his attention, is obviously the KISS rule. Keep it simple, stupid. Many times I have had entrepreneurs come to me with projects, talking about how, either it's too complex that I can't understand, and we got to figure, that goes to one point I'll talk about later, is that VCs really aren't that smart. A lot of times they're much less intelligent than the people that are presenting to them. So they really, it's very important that you try to dumb things down, keep, the language simple, keep it accessible, because even though that person might not be the investor in your project, he may want to refer you to somebody else, but he's going to have a very hard time doing it if he doesn't understand what you're doing, okay? And that's also very important in terms of the overall business plan or basically your own pitch. Don't try to attack every market or try to talk about 10 different sources of revenue. Try to focus down to a specific market, a specific niche that you will dominate and how you will dominate it. It's much more important to communicate something simple than it is to try to cover all corners. Go back. Tied to the KISS principle is focus. A lot of times, entrepreneurs will fail in their discussions with VCs, although they'll fail in trying to come to an understanding because they lack focus. They're all over the place. They don't. When they say, okay, well, I'm going into a very broad market, but they don't know. They can't talk about specifically which market to them is interesting, which market is the one that they need to focus on. So I think this is also very important to concentrate in the sense that it's very important that you know precisely who you were serving, what is the key advantage that you were bringing to them. Okay. Fourthly, I think this is also very important, it's something I always tell anybody who's ever talking to a VC, is that there's no such thing as a perfect pitch. Okay? I'm sort of going into what my colleagues will be talking about tomorrow in one of the workshops, where they'll be talking to you about how to develop, the perfect pitch deck. But the reality is that you can never be good enough. This is something that obviously you're going to have to practice continuously, and you're always going to be able to, obviously, the first contact with the VC, even though it's not successful, may not be the end of the relationship. Because at the end of the day, a lot of times VCs will talk to projects, and on a first scale, they may not be the degree of development that is of interest to them. But maybe further down the line, there may be a new opportunity, there may be new developments where a no today can turn into a yes tomorrow. Okay? So always be ready to improve your message, improve the way you communicate it. Try to find out what the VC is looking for and improve your pitch and adjust your pitch so that you're on the same wavelength. I think this is also a very important point. And a lot of people, I mean, sometimes when you're talking to people, they get a bit upset when they're talking to VCs in the sense that they're wondering why the VC doesn't see the value or the potential in the product you're pitching to them. And the reality is that VCs are very short-term in their focus. Okay? It's more important for us to show or see what you've done to date, how you've worked with your team to date, than it is what you will do tomorrow. Okay? And like I said, you're really not as good, you're only really as good as your last milestone and your ability to demonstrate that you have a capability to execute. Okay? Because what really matters, what a VC is looking for, is not just a good idea, not just a good market opportunity, but he's also looking for people that can demonstrate or can show demonstrable created value in what they've done to date. I mean, a lot of times we tend to always, a lot of times when you're pitching an idea, people tend to pitch an idea based on a business plan that goes out into 5, 6 years down the line. When in reality, entrepreneurship is really a series of steps. What you're doing is working to the next funding milestone and to build your project. So a lot of things can change during time, and so really what's really important to show is how you've created value to date and how you will create value tomorrow, and that should really be going in an 18 to 24-month time horizon. Okay, now this one maybe is a bit of a secret. I mean, I don't know. Is really, a lot of times, a lot of focus when pitching an idea, trying to sell an idea to a VC, a lot of focus a lot of times is on the financial projections. Because you figure you're talking to a finance guy, he wants to see how many sales you're going to generate, what your profits are going to be. But the reality is, they're really not that important. And it really comes down to, and I use a quote here from Steve Blank, is that in a startup, no business plan survives the first contact with customers. I mean, we as VCs are fully aware that, at least in my experience in the 12 years that I've been working in this area, that business plans, when they're presented to us, rarely are executed, or the numbers rarely meet the numbers that are presented on the business plan. Really, business plans, financial projections really are more of an analytical exercise and a way for the VC to measure the team's ability to analyze the options and see how they create economic value than really a roadmap as to what the future of the company is going to be. Okay? So really, financials are important. It's important that you can show an ability to sort of, based on your market analysis, extract that into, an economic analysis that will demonstrate the financial viability of the enterprise, assuming that everything is assumed in the financial plan, which we know will change over time. But the fact that the team can analyze and do that is what's important to see, not the numbers in themselves. Okay? Which then sort of jumps to my next point, which is traditional metrics don't matter. Okay? A lot of times, I've seen a lot of business plans presented to me, and one of the main investment arguments is that you're going to have an IRR of 10,000%, that you're going to have, a net present value of $3 billion. And reality is that doesn't matter. Nobody looks at that. Nobody believes in those numbers. Okay? Generally, I mean, I think it's very important is that a VC, the way he looks at a startup, and when you're looking at him, you're negotiating valuation, you're negotiating shareholding, is the fact that VC is a transaction-based activity. Okay? We don't invest in companies. I mean, obviously, we invest in companies in the sense that, we want to build them up into bigger companies, but generally, the way we make our money is either by, investing in a startup and then eventually having that bought out by a big multinational, or, in best case scenario, we take it to IPO. Okay? But what's going to matter there is not how much we think the business is going to be worth intrinsically, but how much eventually we can sell it for when we finally get an opportunity of an exit. VCs are very exit-oriented in the sense that we tend to be in companies for a period of generally, in the best case scenario, for 5 to 7 years. Okay? So after 5 to 7 years, we tend to get very impatient. And because we get impatient, we have to find something to buy. So we're transaction oriented. So for us, it's more important for you to, when you're talking to a VC and you're trying to pitch, the investment case to him as to why he should invest in your business, it's probably better for you to look at examples of companies that are comparable to yourselves and say, okay, and that have already been successful and that have already been sold in the market and say, okay, well, today I'm small, But if I build up my business, I can potentially, provide you an opportunity to sell this company for like 10 times more what you've invested, or 20 times more you've invested, because there's been this company so-and-so, and this company so-and-so, recently was transacted, and they sold for so much. So based on the percentage of the company that I'm willing to give you for your investment, we expect we can provide you this kind of return. And that's really the way VCs think. They don't think in terms of net present value. That's more of an investment perspective, whereas VC really looks at things more from a market perspective. Because in true reality is, VC is a market activity. Okay. 8, I think this is probably no surprise to anybody as well, is that price does not equal value. Because VC is a market activity, and again, sometimes there's maybe some, inability for VCs and the entrepreneur's expectations to be met, is that in fact price is not equal to value. Generally, obviously entrepreneurs, because they invest a lot of their time and their effort into the business, obviously tend to think more in terms of value. So whenever you're negotiating with a VC term sheet or whatever, valuation is a big issue, because you've put a lot of yourself into it. But in reality is, what drives VC investment, what drives valuation, is more of a price mechanism, which is more market, it's more dependent on demand and supply. It's based on the supply, obviously, of VC money and the demand for new opportunities versus the supply of startups and good opportunities. And generally, what you'll find is that valuations will tend to fluctuate over time. That's why, nowadays, if you happen to be in Silicon Valley and you're in the social, I don't know how the market is now, but, generally, people tend to talk about, that the market is frothy right now because there's a lot of VC money chasing around, these big IPOs. With Twitter now being valued almost at $20 billion, with Facebook having, had a $100 billion valuation. I mean, obviously everybody's getting very excited, and this tends to drive, VC demand because they want to get onto the big next thing because, IPO market's heating up and they want to get in. Now valuations are hot. After 2000, after the bubble burst, valuations were very low and it was very difficult to raise money. So really, the kind of valuation you can get when you're negotiating with the VC and the percentage stake that you're going to have to give up for a particular investment in your company will vary over time. And really, although it is tied to a certain degree to value, because in the case of a startup, value in terms of the true sense of the word in terms of future cash flows is so far down the line, it's very difficult to try to pin a value on a startup. So generally, what tends to drive valuations is more a pricing mechanism in terms of VC availability as well as opportunities for exit. Okay. So like I said, sometimes, and why do I bring this up? And this is the fact. Okay. Nobody's hearing me. The reason I bring this up is that a lot of times when you're doing a fundraising, this is a very important concept to have in terms of when is the best time to raise capital. That's when, and that goes back to an initial point which I talked about, which is milestones. A lot of times when you're trying, obviously you're going to raise a seed round, then maybe you may do an angel round, and then once you start getting to the VC level, obviously you've gone from sort of the initial sort of like uncertain startup to something that's actually more palpable. Okay, and where you begin to gain market traction. So when you start getting to that point, it's really important to really plan when you're going to fundraise and the conditions of the market, because obviously if you're in a bad time of the market, obviously the percentage you're going to have to give up of your company for a certain level of investment is going to be a lot higher if the market's bad, and if pricing is bad versus when the pricing is better. So really you have to really pay attention as you're building up your startup, knowing where you are in the development cycle, but also understand where the market is. And sometimes, maybe you'll have, better off to maybe bootstrap for 12 months, until you do that next round so you can get a better valuation if conditions improve, rather than getting the money now because you need the money now and you want to build the next big thing. So very important to play with those two variables. Okay. Ninth is basically a secret that a lot of VCs don't like to mention, is the fact that they're not very smart. Okay, you're always talking about smart money versus dumb money. And VCs, they all like to say that they're smart money because they're experts. The reality is VCs, are generally in most cases just money. Okay, what makes them smart money is their ability to join that money with smart people. And smart people is not only the entrepreneurs but also experts and network that they can bring together to help them make a better decision help them improve the teams, help them improve the project. So really, when you're talking to a VC, don't assume right away that the VC is smart money. Also, don't assume he's dumb money, but look at who he is, who he can bring to your team, he can bring to your project to help it create value, okay? Because money in itself all money is dumb. It's a question, it's the people that manage that money and help you apply that money that make it smart. Okay. And last, I think this is the very important point, and it really, I mean, at the end of the day, this is really what drives VC decisions, is credibility, okay? Among everything else, the most important thing that you can bring to a VC's attention is, or obviously that you have on your CV when you're talking to a VC, is are you credible? And credibility it works on various dimensions. Obviously, credibility has everything to do, with your relationship. What's your past experience? In the past, in the startups that you've had that have failed or that have gone well, what was your relationship? Were you honest? Were you above the board in everything you did? Is very important. But also has to do with the fact that who you have on the team, which doesn't necessarily mean you have to have everybody on the team to fill in the block. I mean, credibility a lot of times could be that you could be like a young team, unknown, but you've been able to catch the attention of some important advisors. And those advisors in themselves are credible people. So a lot of times, one of the things you should be looking for when you're trying to build up a startup is who are the experts in the field, who are the key opinion leaders that I can show my product, that understand what I'm doing and vouch for me when I go talk to a VC. A lot of times, I mean, a lot of the projects that we've gone into, many times is because the person that was involved, the advisor, was somebody that was credible. It was somebody who brought some credibility to the project, regardless of whether the project was very good or not. But the fact we could trust the person who we were investing because they had this person vouching for them was very important. Okay. So like I said, as a last point, I think above all is really how do I bring credibility to the table? How do I ensure that I have enough visibility that how somebody vouch for me that the VC will believe it? Because all VCs, at the end of the day, our due diligence is based on that. When we look at something, first of all, we want to know is who did you come with? Who are the people that are on your advisory board? What is your past experience? Do you have the scientific background to say that you know about the topic you're trying to sell? Because at the end of the day, when you're talking about getting into a relationship with the VC, you're really talking about building up trust. Okay, and what's going to make or break, the successful relationship between yourselves and a VC is if you can maintain that. Because, like I said, you're going to be in bed for at least the next 5 to 7 years. You better make sure that you're on the same wavelength, that you believe in each other. Otherwise, you're just going to make everybody's life hell. VCs are going to be ragging on you. They're not going to be available for the next round, and that's the worst place you can find yourself, especially at a very early stage. Okay. And like I said, that was relatively quick. And that's it. I don't know, anybody have any questions that they'd like to pose or? Sure, please.
Mike, please. I have mine.
Hi, I'm Paul Downing from Dreamstake. My question is really how relevant VCs are to early stage funding of tech startups.
I guess it depends on various factors. Like I said, I think the credibility factor is one of them. I mean, obviously, the fact that if you can get VC backing at an early stage, obviously the fact that you have, if you have a high, first tier VC on your board or participating, obviously gives you a lot of credibility in subsequent rounds. It really depends on how much informality you need at the early stages. Obviously, in the very early stage, if you're talking something very technological, very science-based, where you're still in the prototype phase, maybe not that important. Because obviously there'll be other sources of funding, be it scientific grants, be it specialized technology accelerator funds that can help you there, and you probably make you avoid the formality of being, with a VC, which tends to be more institutional. Later on, as you're trying to raise capital, I mean, having, a first-line VC, on your cap table can be very, very important. So really, it's a question of opportunity and the nature of the startup.
Thanks.
Hello, Walter. My question, Paul Bell from ProInnov, is a little bit in sequence of before. For instance, imagine a group of students that will trying to have a startup. How much money do they need to have? Can they go talk with you, or should they talk before with a business angel? What's the road you suggest?
It depends on the amount of validation. Okay, so I mean, like I said, we focus on businesses, not ideas. So if you're still very much in the ideation phase, it's probably a bit early to talk to VC, because VCs, they want to see some signs of traction, or some kind of market validation to demonstrate the market acceptance of the project that you're pitching to them. And like I said, if you're a group of students, you have an idea, you're much better off probably getting involved first with more informal capital, such as a business angel or friends and family or a high net worth individual that sympathizes with your idea and helps you build it at the initial phases, and allows you to provide some evidence of market traction, of demand for your product before you talk to VC. Do talking outright to VC. It's very, very difficult just to go with an idea to a VC, because the VC won't have the time for you. I'll be quite honest. That's reality. Whereas if you come with some kind, like I said, again, going back to what I said, if you bring somebody that that's already has a relationship developed with the VC, so he's had previous startups and he's willing to help you, so he brings credibility to your project, and you've brought evidence of market traction that you've already implemented an alpha or a beta prototype of your idea, and you can demonstrate that the market, that there's been market uptake. It provides a much stronger argument and facilitates the subsequent contact. I said VCs aren't very good. I mean, I would say are actually bad for very, very early stages, unless you're like a pharma thing where you need lots of capital. Because I mean, quite honestly, all they're going to do is just make your life a bit much more difficult, because they'll impose all kinds of reporting requirements on you, which you don't need at an early stage. But later on, obviously, when you're trying to scale up, when you've demonstrated some evidence that that you've got the next big thing, then they can become useful.
More questions? We still have about 3 minutes, so I suggest we take the time to... There, another one there. That lady over there.
Hello, good morning. I'm Maria Truninger. I'm a researcher in social emotional competencies. I would like to ask you about the human capacity of the venture team, or of the startup team. What do you look for, and what is typically what you find in successful startups in terms of the human capacity of the team?
Like I said, it's a very subjective. It's very difficult. I mean, obviously, in the first contact for VC to have that kind of sensibility. That's why I said the advisors are important, because obviously, what a VC is going to look for, more than external evidence from the team. I mean, obviously, we look. We want to see a team that's confident. We want to see a CEO that's has good communication capabilities. But you're not really evaluating the team in those first few contacts. You're evaluating their presentation skills. You're evaluating their communication skills, which are important, but not in themselves the only ingredient. Okay, so if you can ally, obviously, those, like I said, the ability to pitch well your idea, and not being a known quantity in the market, because like I said, VC is a market, and they tend to like to transact with people that they know, that they've had previous experience with. So if in the team itself you don't have that type of curriculum developed, but you can bring somebody that's an advisor that you've had a relationship with in the past, that understands your project, and that can vouch for you, and that's somebody that's had a relationship with that VC, that's had that experience, it provides a greater signal to the VC that you have that capability. Because it's not just you yourself, but it's somebody that's already had a relationship with you and with that particular VC that's going to give them that comfort, that there's a high probability that those qualities that we need for a successful startup exist. Okay.
Another one there. We still have like 30 seconds, so...
And now it's picking up.
Hi, my name is Bruno, and I would like you to present a case study in technology area.
A case study of what?
Yes, with the Caixa Capital.
A case study of Caixa Capital. Well, I have very many. I think, again, going back to point one, focus, please. Can you be more specific?
Some project that you have supported,
Yes.
you know, in early stage or in startup level.
Yes.
Could you tell me one?
Well, there are various. At least in the 50, there's a few of them that we're invested in. So, I don't know. It's like I said, there's many. We do things. We cover the board. We do stuff from. We have some biomedical devices like we have pure IT,
Okay.
web, mobile. So it's
Volvo.
various. Yeah. So
Your time is up. So
Okay,
congratulations and thanks a lot.